God. Sorry about that, everybody. I don't know why I wasn't up here as a speaker. Let's wait for Mark and then we'll go ahead and start it. You know what? Maybe I'll just go ahead and start with a few quick updates. I'm sure Mark will go ahead and join us here in a second. Okay, so I have three quick updates before we jump right into carbon. First, I'll start with the latest update on the migration process. The ability for users, Glenn, you can hear me okay, right?
Yeah, you're good on my end. Can you hear me?
I
Test, test,
can.
test. You're good on my end, I said.
Okay,
All right,
awesome. I
good.
figured before I get too far, maybe I should just double check. Okay, so in terms of the migration process, the ability for users to migrate from V2.1 to V3 was originally scheduled to be permanently disabled on November 16th. That, for the moment, has been extended. An update was posted to governance in the Telegram channels, along with Discord if you haven't seen it. There was a request from the community and DAO to have the latest data regarding the amount of protocol owned liquidity migrated from V2.1 to V3 and the expected effect on the deficit to be released prior to the end of phase one. The numbers are still being generated and is a partial reason for the extension of the first phase. Once they're calculated, though, they'll be posted in governance and shared throughout the channels. Second reason for extending phase one is due to new code being implemented. Rather than rush this process and any changes being made on the smart contract level and possibly, sacrificing the overall security of the protocol, it just made sense to extend the user's ability to migrate from V2.1 to V3 while this additional testing was occurring. So if you're still on V2.1, would like to migrate your funds to V3, you do still have time, although that time will be limited to 24 hours once the latest numbers regarding protocol owned liquidity are posted to governance. As soon as they're available, or any updates in general are available, they'll be shared with the DAO and community on governance, posted to the ongoing migration discussion, and shared throughout the Bancor Telegram channels, pinned to the top, and in the announcements channel in Discord. Next is Almanac. Last week, they started their on-off curve liquidity trading fees recommendations for the WBTC, ETH, Link, and DAI pools. We should be receiving an update from them posted to the Almanac discussion on governance early this week with the results those recommendations have produced. Lastly, we have a new proposal in governance. It's improved value capture and fast lane POC, proof of concept. There are two parts to this proposal. I just want to take a second to highlight the second half really quickly, as it allows a wallet to be exempt from pool fees if it arbs the protocol and uses gains to reduce the deficit. So the bot is not getting any financial upside. It 100% exists to serve the protocol. If you haven't already read through that, I really want to encourage everybody to take a look, go to governance, and check out that new proposal. Mark, I see, has joined us. We'll move on to carbon now. An hour or so ago, a tweet was shared in all of our channels introducing carbon to everyone. If you haven't seen that yet, it should be, well, it is pinned to the top. Definitely want to read through that, read through the Twitter thread. I, for one, am certainly excited to finally be able to speak about it so openly with Mark and all of you here. And like I said, it's an introductory thread with a description of what carbon is, what it enables, what it offers solutions for, and how it's powered, along with links to the new carbon medium, light paper, and simulator. It also includes an announcement with a reminder link for the first carbon Twitter spaces happening this Tuesday. I'm actually going to use this Twitter thread as somewhat of a guide just because it's so new. It's really the first sort of like written communication in terms of carbon in the community. So, Mark, if you wouldn't mind, I kind of want to dig into this a bit with you and everyone here.
Please.
Okay, so first it says carbon is a new form of on-chain liquidity designed for personalized trading and market making strategies. Deployed strategies composed of multiple on-chain limit and range orders for any given token pair, with each pair or each order represented by a unique bonding curve. So strategies composed of multiple on-chain limit and range orders. What is a strategy in this context?
Yeah, so a strategy is essentially the user nominating the precise price ranges in which they want to buy and sell their tokens. So this is in stark contrast to conventional AMM designs, where the AMM gives you its own trading strategy, and you essentially have to contribute your tokens to that strategy. So the canonical example is the constant product AMM, which essentially you, whether or not you know it, as a liquidity provider on one, you are essentially making the claim or the bet that the markets are going to trade more or less sideways with some sort of intermediate volatility in which you are going to earn fees over. And it's when when the markets don't trade sideways, right? When one token starts gaining over another, that you start to essentially lose value over the hodl positions. This is what results in permanent loss. But you should note that impermanent loss is something that has only been coined sort of since the advent of constant product market makers and users contributing liquidity to them. We've never really spoken about IL in before AMMs. But that's not to say that users weren't contributing liquidity to trading strategies before then. And so this is something that has been executed with great success for decades, if not nearly a century, on centralized exchanges in commodities markets and other things. And it's essentially just making some call, right? Agreeing to buy something at a price that you're happy to buy it at. Usually some sort of discount relative to what you think its fair valuation is. And then to sell it when the price increases. In a way, this is the most fundamental, the most elemental of economic paradigms, right? To buy something when the price is low and sell it when the price is high. And traditional AMMs don't really allow you to do that. They kind of do. Like I'm willing to entertain those arguments, and I'm sure that you have opportunity to hear me discuss these concepts in more detail with people over the next few months and years. But where carbon is very, very different is that you get to choose precisely what those execution prices are. And so that is the strategy. The strategy is that you have some expectation of how the markets are going to move, and then you nominate where you want to buy and sell your tokens based on that expectation. And that is your strategy, right? This is something that people make a living off of, right? There are professional traders, day traders specifically, that do nothing more than trade volatility in the markets this way. So it is, it is a highly successful and very profitable enterprise, but it hasn't really been something that you can do on an AMM until now. There are sort of close analogs. I'd say that there are a lot of AMM designs that have come sort of close to achieving it, but I think that they were still trying to sort of adhere to some sort of underlying presuppositions about how AMMs should behave, or maybe some misapprehensions about what the limitations are. And so with Carbon, we've basically thrown away all of these assumptions that we've had about what AMMs should do, and have just introduced essentially an order book style model, but one that gives users a much broader scope of potential activities that actually starts to overshadow what you can achieve on a centralized exchange as well. So it's not just limit orders, right? A strategy in this case is something that's much more sophisticated than that. And yeah, it's the I think that that's probably the best rendition that I can give you of what a strategy is. But I'm sure that as people start using it, that there will be many a Twitter thread and YouTube video describing how people are using it and whether or not that's been successful for them.
Yeah, no, I appreciate that, because as like liquidity providers, or me personally speaking as a liquidity provider, you don't necessarily see yourself as a trader. But then when you
Right.
learn that this strategy is almost predefined, for you, and now you have the ability to create your own personalized trading strategies, like that says a lot. What about
I
go
I
ahead.
think that one of the things that that I was studying, as I was getting into cryptocurrency, late in 2019, early in 2020, is YouTube channels like Benjamin Cohen, right? There are these very sober crypto enthusiasts that aren't necessarily sort of cultists, right? They're not the revolutionaries of cryptocurrency. And that's not to say that I don't have enormous respect for the revolutionaries. I even count myself among them. But there is an enormous demographic that sees cryptocurrency as being a tradable resource like any other. And if you have a look at the kinds of things that they do, right, they're not the kind of people that say that they're holding on for dear life, or that they have diamond hands or anything like that. Rather, they take a much more considered approach to the cryptocurrency markets in general. And if you have a look at the types of metrics and things and the discussions that they have with their communities, they generally set targets, right? They note that Bitcoin is going to have rallies and it's going to have capitulations, and the time to be buying tokens is when they're capitulating, right, during these accumulation phases, and then the time to be selling them is during the rally. One of the I think one of the best introductions that you can have to this type of trading education probably is Ben Cohen's channel. If you haven't seen it before, I do recommend it. But he has a very sort of data science based approach to Bitcoin specifically, right? I'm not sure if he trades anything else. He seems to only talk about Bitcoin. But he has this sort of metric where, based on what he considers to be the fair valuation of Bitcoin based on an exponential, a logarithmic regression model, how aggressively he's buying Bitcoin based on its current trends and its current price. And sort of paradoxically, or at least for newcomers in trading, he's buying more and more aggressively as the price of Bitcoin comes down, and then sells it more and more aggressively as the price of Bitcoin comes up. And in a way, this is what keeps markets liquid, right? It's really important for our new burgeoning industry to find liquidity for the assets that underpin everything that we do. And it's worth pointing out that during things like the FTX catastrophe, the collapse that happened there, there's been a lot of discussion about sort of the insolvency or the alleged insolvency of FTX, but at its heart, it was actually a liquidity problem, right? It was mostly that it wasn't necessarily the fact that FTX was uncollateralized, but the fact that its loans were collateralized by tokens that were horrifically illiquid. And this is something that I sometimes start to feel like a broken record when I say that I think that the number one problem facing all of cryptocurrency is its liquidity issues, and it's the thing that kind of keeps me focused and and makes me so excited to keep developing liquidity solutions. And in this case, I think that we have something that's quite compelling. because it's really the active buying and selling of these assets that keeps them liquid. And now we have something that actually caters to the specific demographics that contribute to that, that velocity, that liquidity paradigm. So yeah, it is. It's meaningful, and I really do hope that this is going to be sort of an important capstone in the way that we treat on-chain liquidity and how people utilize it.
So you can contribute to, helping maintain a healthy liquidity pool while still not being obligated to those predefined parameters. You can kind of have the best of both worlds, and that's kind of what I'm understanding.
Yeah, it's just the
Helping the
buying and
entire
selling it.
industry.
Yeah,
Go ahead.
yeah. Basically, whenever these tokens change hands, that's a good thing. We want cryptocurrency to flow around as if it was actual currency. And I think one of the things that we often forget, and certainly I've entered into many heated debates with other people, even on our own Twitter spaces, that when during the bull run, for example, it was a very commonly held belief that when token liquidity is drying up on an exchange, that's a bullish case, right? Or that the scarcity of an asset is somehow valuable. But actually, history demonstrates that these things are actually the opposite of what people expect, or the outcome that you should anticipate is the opposite of what people expect. We want people to trade these things frequently, and we want to be able to support them trading them with as little friction as possible. And at the end, right, cryptocurrency, the suffix currency suggests that something is very, very liquid, right? Cash is by definition the most liquid asset. It's why it is as useful as it is. And so in this case, we're trying to support that relative velocity. We're trying to create a system that makes the exchange of these cryptocurrencies much easier. It should be something that is encouraged, I think is what I'm trying to say.
Right, I understand. I want to move on to the second part of the initial tweet. Each order is represented by a unique bonding curve. What does it mean? What does it mean to have a unique bonding curve?
Yeah. So the way that Carbon is set up is such that each token that you provide liquidity with has its own bonding curve. And even though it's part of a pair, and this is just in the first iteration, right? I expect that there will be future versions of this because we've already shown that this can be generalized, where you can create liquidity with any number of assets represented by any number of bonding curves simultaneously. So your strategy doesn't necessarily need to be between 2 tokens, but it could be between 3 tokens or 4 tokens or so on. So this unique bonding curve idea basically comes from some of the early work that, if you remember, months ago, I said that I was looking into dynamic fees. And when I was looking into that, I started to sort of become a little bit uncomfortable with the idea of a bonding curve necessarily being predicated on the balances of more than one token. And I started looking at the idea of having bonding curves that were represented exclusively by the balances of one token. And then just having a price curve that is dependent on some threshold value and the number of tokens that you have left compared to that threshold. And so that's what we mean when we're talking about a unique bonding curve. If you're making, if you're contributing liquidity with a pair, say DAI and ETH, you can set your bonding curve up such that the balances of ETH and DAI affect only their own bonding curves and don't affect the other. And this means that if you have the ambition to buy ETH, I don't know, as it capitulates down below $1,000, you can do that. And the ETH that you are buying in that range doesn't affect the price that you're going to sell it for later. This is, again, in stark contrast to the traditional way that we treat bonding curves as being dependent on the balances of two tokens, which would mean that as you are accumulating ETH in that range, it necessarily pushes down the price that you're going to sell it at. And so this is the unique bonding curve and asymmetric liquidity paradigm that Carbon is introducing.
So the example given in the Twitter thread was a set of strategies that buys ETH between 1,200 and 1,300 USDC. That's one curve. And then sells ETH between 1,500 and 1,600 USDC. That's another curve. And ETH accumulated in the first instantly becomes available in the second.
Correct.
So you
can even start bonding curves, with these with Carbon, where one of the bonding curves has a token balance of 0 if you want to. So, for example, you can construct a bonding curve to buy ETH with DAI as it capitulates below 1,000, for example, and then start another bonding curve simultaneously that sells that ETH after it reaches, I don't know, $15,000, $20,000, whatever your most hopeful ambitions are for the price of ETH in the future. But that doesn't mean that you need to actually provide ETH when you're setting up that bonding curve. The DAI you can provide just the DAI and wait for the ETH price to drop into the range that you hope to buy it at. And as you're buying it, that ETH will immediately become available in that other range, on that other bonding curve that used to have a token balance of 0. And as it accumulates ETH, as I said before, it doesn't change the price that the user sets. And this is that individuality, giving agency back to the liquidity provider to determine exactly how their tokens are used and what prices they are bought and sold at.
Okay, so speaking of strategies, right? One of them mentioned is automated buy low, sell high strategies, the average in orders, limit orders, right? There's a couple parts of that I want to kind of get into. And I think it's pretty safe to say the majority of us have heard of buy low, sell high strategies like you were speaking to earlier. But what is it about them and these strategies being automated that brings so much value?
Yeah, okay. So there's a couple of different ways to look at it. And the first one I think we should get out of the way is tax implications. And this is going to be, it's going to be obviously dependent on which tax jurisdiction that you're in. But for a lot of these kinds of DeFi protocols, especially, I live in Australia, and in these types of situations, the liquidity that you contribute to an AMM is only really taxable after you withdraw it from the AMM. And so if you're just holding on to a pool token or something that represents the underlying liquidity, it's treated as capital gains. And so if you're in a jurisdiction that taxes you on capital gains with unrealized gains, then that's very unfortunate. But in a lot of jurisdictions, you don't have to do that. Whereas when you're buying and selling actively on an exchange where the tokens immediately end up back in your account, that actually generally triggers an immediate taxable event. So that's one important component of the automation, because the tokens remain as a part of this product that you've created. Then it's generally only realized as a taxable income at the time that you dispose of it, which is, I think, the usual the language that tax authorities use to describe it. So that's an important component. So let's just get that one out of the way.
I'm just going to do your disclaimer. I'm just going to say your disclaimer for you. Obviously, that's not tax advice.
Yeah, of course. Yeah, not tax advice. You should always consult your tax attorney or whoever it is that does your accounts to make sure of that. And again, right, I want to stress that this is very jurisdiction dependent. But obviously, as an exchange product, these are the kinds of things that we need to be paying attention to. And if that does give someone a tax benefit, then it's very helpful to provide that. Other than that, it's also important to note that these kinds of strategies that we're offering with Carbon and the fact that they're automated means that you don't have to pay like continuing gas fees in order to withdraw or move your liquidity around. We've set up the contracts in such a way such that actually user liquidity isn't pooled together, but you own essentially your own individual liquidity pool. And this means that if you want to change your strategy, like maybe you're changing your mind about which way the markets are headed, or maybe you get cold feet and you want to withdraw your liquidity, or for whatever reason you want to edit that strategy. The status quo in DeFi is that you have to withdraw your liquidity from some range if you're using a concentrated liquidity AMM, and then recontribute tokens back to another range, right? It's like taking tokens out of one box and then moving them into another box. Whereas on Carbon, because the parameterization of your curve is yours and yours only, you can just update the way that curve behaves. You can even switch it off and leave your tokens where they are and just have them be untradeable. So adjusting your position and managing your strategy over time, which is something that because of the nature of Carbon, you probably won't have to do very often. But if you do want to, it's the gas overheads are very, very low, right, compared to competing products, which is pretty helpful. The other aspect of the automation is that because it is because the two curves are sort of linked, or at least they can move token balances between each other. You can set up like the strategy in sort of a self-fulfilling way. So on a conventional centralized exchange, if you wanted to achieve something like what we're offering with Carbon, and you can, but what you would generally have to do is set up dozens and dozens of different different limit orders. So, for example, and again, I'll refer back to Bancor because I think that he's an excellent authority to appeal to here. Let's say that you've accumulated a bunch of Bitcoin back in the COVID crash in 2020 at $3,000, and you decide that Bitcoin might go to it might go to 100,000, it might go to 50,000. You don't really know yet. So what you might do is set up a bunch of limit orders on the way up, right? You want to be taking profits on the Bitcoins that you've bought. And because you're not certain of exactly where the top is going to be, you kind of have to hedge your bets a little bit and choose a bunch of different prices to execute. As you're doing that, as those limit orders are being fulfilled, the US dollars, for example, that it's being sold for is generally not being then contributed back to another limit order in order to fulfill a strategy over long periods of time. What you would have to do is come back and check every day or every week or something to see which limit orders have been fulfilled, and then to take those US dollars and put them into another limit order to buy Bitcoin, for example, on the way back down. Whereas in Carbon, you can just tell the protocol exactly what it is that you want your strategy to achieve over time. And it knows that if it's selling wrapped Bitcoin, for example, for DAI, then that DAI is going to move back through your buy low range for Bitcoin and remain there until someone uses it. And so that's a big difference, right? We still get to maintain that kind of set and forget lazy mentality that I think that we discovered the market has an appetite for with our previous products. But this time, rather than subscribing to the protocol's own trading strategy, you can now implement your own trading strategy. And that means that we've also got a platform for traders to really show us their mettle, right? I think that there's going to be a lot of opportunity here for bragging rights and other things where traders can have a stage, right, a self-promotion avenue where they can demonstrate on chain exactly how well they're how well their trading skills can perform. And I think that there's a huge market for that, right? I think it's the number one driver of YouTube views, for example, in crypto, although that is slightly declining right now, but it certainly drives a massive audience, and I'm expecting that that's going to be, I expect there's going to be a lot of eyeballs on the protocol as some of these professional traders decide to move their strategies off of centralized exchanges and onto Carbon for its DeFi counterpart.
It really just simplifies the entire process and eliminates so many steps rather than having to set all of these orders and then take all of that and put it into another order. You're literally it's just rotating. Like you said, that's kind of where the adjust it on the fly. If you want to swap that, like change that out, you can. They're linked together. One thing we didn't touch on, Mark, that I want to ask you to touch on is resistant to MEV sandwich attacks.
Yeah.
Can you speak to that and the importance of it?
Yeah, for sure. So one of the big problems, right, that exchanges in DeFi and on Ethereum in particular have always struggled with is this thing that we call a sandwich attack, and I can describe that just briefly. If you are going to trade a token on, say, Uniswap V2, which is where most of the sandwich attacks occur, and someone sees that trade hasn't been processed yet, maybe it's floating around in the mempool. What a miner might do is include your transaction in their block, but sandwich it between two transactions of their own on the same pool. And what this usually looks like is that they will process a very, very large trade in front of yours as an effective front run. They might use a flash loan or something similar in order to drive the price on that pool like way out of what you were expecting to get. And that means that when you go to trade on that pool, you're getting a much worse exchange rate than you were expecting. Now, the reason why the miner doesn't mind doing that is because they know, because of the symmetry that these AMM pools provide them, that they can, after they've processed your transaction, that they can then back run it, right? And this is why it's called a sandwich attack, right? Because they front run your trade, process your trade, and then back run both of them to bring the pool back into balance. And so this has the net effect of essentially providing them a much larger arbitrage opportunity. And if they are, for example, the major liquidity provider in that pool at the same time, then they can also skim off a massive amount of fees from the trade that they sandwiched. And so it's generally, it's a very highly exploitative activity. It's not like arbitrage or something, which I consider to be completely benign. It's a deliberate attack, right? It's effectively stealing funds from people that are trying to trade. So the reason why this works is because the back run is always available, right? Because the liquidity is symmetric. Then all of the tokens that they bought from the pool, they can then sell back to the pool at the same price. On Carbon, that's no longer going to be true. If someone is sandwich attacking someone on something like UniV2 and manages to drive the price of Ethereum up to $400,000 or something, which is, by the way, not out of the realm of possibility for some of these sandwich attacks. On Carbon, that price movement would become permanent, right? So if someone was to attempt to sandwich attack someone who is trading on our system, they won't be able to refund their front run. And so while you can still be front run, the miner is going to pay a huge toll for that. And it basically removes all of the incentive for doing so. So the irreversibility, right, the asymmetry of the system, it actually removes the most common, the most exploitative attack vector that's currently used to prey on naive DeFi users, and that's a huge positive.
Thank you for explaining that so well. But speaking of the irreversible on execution, and the asymmetry, like the asymmetric liquidity, this I think was a confusing thing for some of our community members. I saw some comments in there, and I want to see if we can explain it a little bit better. When I personally, until you had explained it, I'm thinking irreversible. If I send you, USDC or ETH, whatever it happens to be, I make a mistake in the wallet that I'm sending it to, there is no reversing that transaction. That was kind of what I was thinking. Maybe we can break down what we actually mean by irreversible in this context.
Yeah. Okay. So, let's imagine, so most people in cryptocurrency kind of have the same ambitions for the future, right? Everyone's hoping to sort of get in early because they think that a lot of these, cryptocurrencies are going to appreciate in value over time. And so, there are some of these amazing success stories like, the Bitcoin pizza or something, right? Where I think someone bought a couple of large pizzas from Papa John's, and the Bitcoins that they paid for those pizzas with are now worth, I think, almost a third of the total market cap of Papa John's pizza chain, right? So it's a huge amount of money now. Imagine if the guy that bought those pizzas was like, yeah, I've changed my mind. I'm going to give you the pizzas back and you give me back my Bitcoin. That's effectively what AMMs do, right? If the price moves up, right, as a liquidity provider, you could be like, yeah, I'm really excited to now have, this, these coins or something that are now worth a lot of value. But when the market turns around, that value that you've accumulated immediately leaves. And this is the problem with that symmetry. And that symmetry is the reversibility that you're referring to. If I was Papa John's and I, effectively bought Bitcoin at a ridiculous low price of 2 large pizzas, and then, later on after the Bitcoin price started to climb, to have that customer then say, actually, I want a refund, you can have these pizzas back, it doesn't seem fair because, we brokered a deal, right? We exchanged goods, and now we kind of, are supposed to live with our choice. And for some reason on AMMs, liquidity providers are always getting the short end of the stick because they're always forced to be left with a balance of tokens that is, let's say, unfairly biased towards the thing that is the least valuable of the two. So you're kind of always missing out on your advantage and kind of self-sacrificing in the sense that you're happy to accumulate tokens that are always moving down in price. And this has been pointed out many, many times, right? The only winning market movements for AMM participants generally is when markets trend sideways and never move up or down. Whereas on carbon, you can actually start to take advantage of market movements that aren't just sideways, right? Where you can, for example, range trade something or channel trade something. So it just opens up, a lot more, a lot more user agency, right? Through being able to hold on to the tokens that they've bought. And that's what I'm talking about when I talk about irreversibility. If you buy something at some price, you are no longer forced to sell it back to the market at the same price that you bought it for, right? It's a no refunds policy.
Right. Okay. I understand. Now, in terms of the strategies, it's not just one strategy that users can create. They can create multiple strategies with any ERC20s. Is that correct?
Yeah. I mean, it depends on what you mean by multiple strategies. Do you mean with the same pair, or like can you be a bit more precise?
Sure. So say I have two different pairs.
Yeah. Okay.
I'm not going to be limited as a user to one specific strategy in terms of this pair. I can create multiple.
Yeah, you can. Yeah, so for any pair or for any number of pairs, you can have an arbitrary number of strategies running simultaneously.
Perfect. Thank you. I don't believe I have any other questions for you, but if you want to really highlight anything specific, please do.
I think that the you know from some of the things that I've seen, posted in private correspondences and in the channels since we've started speaking about this, and the fact that the white paper's out now, we've got the simulator out and everything else. One of the things that was really heartening was to see how fast people understood what its purpose was, and I think that that is a very good reason to feel encouraged, right? That this was a worthwhile endeavor, and I'm glad that we, that we took the time that was necessary to develop it out properly. But I think that the one that I wanted to share was someone sent, one of the contributors, their own summary, I guess, of what they thought that the protocol is capable of doing. And they described it as, an automated trading bot that fulfills your limit orders gaslessly. And I think that that is a really good approximation, right? One sentence, off the cuff comment that kind of captures exactly what Carbon can do. But I also want to add that it's actually so much more than that. The flexibility that you have with these things, the fact that our adjustable bond curves have no tick ranges, right? That you can set literally any price. The fact that you can drive your price range infinitely close together and create a constant price bonding curve, which is something that even our competing AMM concentrated liquidity products aren't capable of. And even there are things that we have alluded to, certainly alluded to in the patent application, that we haven't discussed in the light paper or white paper yet, that actually opens up all kinds of new economic paradigms for things that already have a counterpart in traditional finance or in commodities markets. And so I just wanted to say that the value of it, the reason for this thing needing to exist seems apparent, and I'm glad to see that the people that are paying attention are able to articulate exactly what that purpose is without us having to explain it to them. Right, that's a really good sign. But I also want to point out that there are some nuances to this, right? Some sort of like a type of secret hidden power that this type of AMM can achieve. That I haven't seen anyone discuss yet, and that is also encouraging, because it means that we're going to have a lot to speak about over time. And so I think that it's just an exciting time to be associated with the project, and I hope that everyone is as optimistic as I am that this is going to be a game changer for DeFi.
Absolutely. Thank you so much, Mark. I know that we're going to have a whole bunch more questions, especially now that the light paper has been released and the blog has been released. Again, if anybody hasn't seen that tweet, it was tweeted originally by the New Carbon Twitter and shared by Bancor's as well. And it includes the medium for Carbon, the light paper, and the Carbon simulator. So all of your questions in that, as well as the reminder, like I said, for the Twitter Spaces, the first Carbon Twitter Spaces on Tuesday, and includes a form that you can fill out and submit all of your questions. So during that Twitter Spaces, we're going to take all those questions. We're going to have answers for them, Mark, best we can. I'm sure a lot of them will have to do with timelines and things, so we'll look into that. But definitely check out all of those new resources that were just released this morning. And I look forward to speaking with everybody and having answers to all of them on Tuesday. Thank you, Mark. And thank you to everybody who joined us.